Every day, there's another announcement. A startup has gone public.
It's a veritable IPO gold rush, making founders and VCs very, very wealthy.
But is everyone a winner? What's the risk to the innovation economy?
Today, the IPO Gold Rush on Future Forward. I'm Stephen Rosenbaum.
And I'm Alexis Corrado. Let's launch.
Hey, Alexa.
Hey, Steve.
I have to tell you, as we were working on the script for this story, my first reaction was, oh my God, this is so great. How is this not fabulous? And then we dug in, and it turns out maybe less fabulous than meets the eye. So, and you know, it's very tricky to get people to talk about the dark side of IPOs. Like, it's interesting.
I think most people don't even really understand it. Like, I'm amazed at the amount of people who I've hired, colleagues, past, present, who just don't have the fluency in stocks, shares, IPOs, and kind of what it means. So, I mean, I guess maybe just starting from there, Steve, how do you describe what an IPO is to someone who doesn't know?
So let's talk about the birth of a startup. So startup begins when two women or two men or a man and a woman or three women and a, whatever, in a garage or a study or somewhere at a school, decide they have this idea. Yeah, or WeWork. Yeah, right. They have this idea that they're going to build a company, and they do it. They rub some nickels together and do it with friends and family. You throw in a couple bucks, but fairly quickly they need money, and so they take their hat and they go out and they type into Google venture capital and fintech, or venture capital and fashion or food, and they find a bunch of VCs and they go and beg for money. And the VCs, if they go to enough of them, they find one or two who likes either the idea or their history or the vibe of the startups, and they give them a fairly small amount of money for a rather large piece of the company. And then over the course of, I'm obviously oversimplifying, but then over the course of between 3 and 15 years, this company starts to become profitable. It makes a little bit of money. They raise more money. It grows a little bit. Now they're in a place where the VCs say to them, hey, we have limited partners on our fund, and they were looking, given all your success with XYZ company, we'd kind of like our money back. And we'd like it back kind of at a 10x return. So if we put in $100, we'd like 1,000. There's only one way to do that. You need to find a pocket with more money that's willing to pay a premium for your company. And that turns out to be a bunch of dentists and doctors and rich individuals and grandmas and people who are doing day trading, who want to buy your company and then buy up the price on the public markets. Have I essentially made that into a Garanimal version of how we get to IPO land?
So, I mean, yeah. I think in one sentence, what I usually describe an IPO as is it's a fundraising event, right? But instead of raising money from private investors, it's the general public.
Right. But to be clear, from a CEO perspective, if you're looking to have a big financial event happen and you have the choice between having your company be bought by Google or Microsoft or Apple or one of these big, cool brand name FANG companies, an IPO is different because your company's still an independent entity. It still needs to keep growing and accruing value. It doesn't have the resources of all of those other companies, that are part of Google, for example. And the thing about public markets that I think gets lost in all the coverage about IPOs is, public markets want to see results every 3 months.
Yep.
It's kind of ruthless quarter to quarter growth, like nobody's high-fiving you if you made $1 million in last quarter and you're making $1 million this quarter.
Right. And you want to see a lot of predictability, no surprises.
I have been told by a couple of CEOs who've IPO'd over the years, how much being a startup CEO does not prepare you to being an IPO public company CEO.
I feel like it's hard to even find examples of startup founders who actually want to make that transition. And the ones who I know who did in their subsequent companies have always found they've always left the CEO seat before the IPO.
So it's why so I did a bunch of reading on this so that I could be educated about the ups and downs for our pod today. And there's very little what I would describe as honest coverage of the emotional impact of an IPO on a founder.
Yeah, it's funny. It's one, the coverage can never happen in real time. So in the 6 months leading up to an IPO, it's usually what they call a dark period. And for employees, you really can't talk about anything. So I've only been through this process once, but I remember going through training with legal and compliance, and they were like, you can't talk to your friends and family about work. We have to lock it down. And so that's probably one factor, right? It's just the real time raw emotions. No one's blogging or tweeting about the IPO process when they're going through it. And then after the IPO process, there's usually a class of shareholders, like founders, early employees, investors, who are in a lockup period. And so they can't sell or they can't trade their shares, because anything they do has to be disclosed to the public. So offloading shares might signal to the market that maybe the promise and potential of the company is not really what it is. Anyway, they're probably
no, totally relevant. And so on paper you've made $1 gazillion.
Yeah.
But until the lockup ends, that $1 gazillion is riding a roller coaster of what happens in the market.
Right. And then transitioning, even if you say okay, I want to transition out of this company or reduce my involvement over the next 2 years, every time you offload shares or even your departure, it's so highly scrutinized. And so it's so calculated, I think, the way people have to show up and disclose in this context, that it makes it really hard to actually get the story unless it's told kind of years in the past.
So, a couple of things as a founder, you don't start a company to get rich. I mean, I guess some people do. But I think, in my case, I can speak, as a focus group of one. You start a company because there's a problem and you think you're uniquely suited to solve it, and solving it's interesting and fun and complicated and challenging. And then they throw the switch and you're a public company, and all of a sudden those problems become, how do we make more money? How do we monetize this? And it's very hard to do long. I mean, this is, Mark Zuckerberg famously said in 2010 when he was asked why they hadn't gone public yet. He said, we think we have problems to solve that have a long time horizon, and we don't want to be, a public company having to be held to quarterly earnings reports. Well, first of all, then he turned out he was, and now he is. And whatever those long time horizon problems are, it seems like maybe, a little harder to solve in the current, shape of the company. But there is another. So in digging around, I stumbled into what appears to be the only research I could find about the impact of an IPO on public companies or on formerly private companies. And I say this with the caveat being this was written in 2013. It is, to the best of my knowledge, having done a couple of hours of research, so maybe there's more, but it's the only study that I was able to find about the impact of IPOs on innovation. And it's not a good story.
Yeah. So this article is from Stanford Business School and basically argues that innovation slows down once you go public. And I think, you can sort of, I feel like in broad strokes, that would make sense, right? Like if you take Facebook as an example, they used to operate through the lens of move fast, break things, right? People used to actually have that as like a mantra, was on posters. And once you're public and a large company, moving fast and breaking things is not how you keep shareholders happy.
What interested me about a bunch of the reading that I did was it essentially said 3 bad things happen. And that, because it's Stanford, they wanted to have something to measure. So they went out looking at patent filings, which is a very tangible thing about, is innovation resulting in patents? And what they found is pretty consistently post-IPO companies' patent filings flattened almost inevitably.
Right. They said so that like 18% of founders are likely to leave, or innovators, inventors. And then something like 46% are of the stayers. They think the quality of patent also goes down.
And that makes sense, right? Because a couple of things have happened, right? So if you're one of those early innovators, you've made money. You've made, somewhere between really good money and, fuck you money, like never have to work again money. And so now all of a sudden you've got this new set of freedoms. You can start something. You can become a VC and start funding startups. You can go and work at one of the big innovation spaces inside of one of these big companies like Alphabet, but with the freedom to know that, you're not having to hit your numbers in order to not lose your job. So, I think, and by the way, I think about this a lot because, I think about some of the changes that Magnify and then Waywire made. And I think, if we were in the other thing is this economy that we're in right now is literally pouring money like a fire hose at IPOs. I think we probably would have positioned ourselves as an IPO. And I don't know that it's hard to say you would have regretted it if somebody backed the truck up and dumped, crisp green dollar bills in your living room. But I can't imagine that my feelings about culture, I can't imagine I would have been a long-term CEO of a public company. I don't think it would suit me.
Mm-hmm.
So it's 3 things. It's some of your key talent gets wealthy and doesn't need to work. Some of your key talent wants to be in a startup vibe. And so having to run things by lawyers all the time is no fun. And then, some of it is just that, the financial constraints make it harder to think about big new ideas.
Yep.
I remember a conversation I had with YouTube when we were Waywire, and we had an idea for a partnership with YouTube, and we went and met with senior execs. And one of them afterwards said to me, they liked the presentation. They said to me afterwards, is this $1 billion idea? Can you project out $1 billion in revenue? And I hadn't really thought about it in terms of a bill. I said, well, if it grows in this way, but it depends on a number of areas. And they're like, the answer has to be unequivocal yes. We literally can't look at anything that's not $1 billion opportunity.
Yep.
And I was like,
Yeah.
wow, that seems like that would take some of the fun right out of it.
You know what's crazy is it's not even just tech where that is sort of like a benchmark. Procter and Gamble also the same thing. Like their portfolio of brands, Gillette, Tide, Bounty, etc. They're all considered billion-dollar brands. And then when brands are on a decline, then they sell them.
All right, so let's talk about some specific companies. It's interesting. So, the other thing, by the way, is that when you Google, IPO 2001, it's a messy set of answers, which I guess I was a little surprised by. So here are a couple of companies that we should just talk about. Let's start with Robinhood. So I don't know Robinhood well, but it doesn't strike me they've been around that long.
No, I think let me see. I'm looking actually at their founding 2013. So they're not even a decade old. They're 8 years old.
But that's still longer than I would have. I mean, I hadn't heard of them until 2 years ago. But it's interesting. So the companies that I'm aware of, and there's a long list. And by the way, listeners who can jump into the chat, happy to add more names. Robinhood, Outbrain, Taboola, Kaltura. They're all companies from my generation. Kaltura was a video platform company back when Magnify was at its heyday, and they slogged it out, and now they're public. Taboola, interestingly enough, so Taboola and Outbrain were originally going to merge, and then they had a whole merger thing, and they weren't able to get it done for reasons that you can Google. And they both now IPO'd
around the same time, which is wild.
Yep. And Duolingo better than I do.
So Duolingo, because for me, I follow the ed tech space really closely. Duolingo is significant. So one, it's language learning, like on a mobile app, and I've used Duolingo to learn Spanish, Italian, and it's cool because it's actually a consumer-facing app. And what's wild to me is it's huge. It's IPOing at a valuation of like $3.1 billion.
But just to be clear, when that gets reported as a $1 billion valuation, that's not money that doesn't sit in a piggy bank that the CEO gets to spend. Right?
No, it's just but it's
well, but that's why I think that. But I think that number is a little it's misleading because you're like, wow, it's $1 billion company. Well, yeah, that's because lots of individuals have shares the total evaluation of $1 billion, but it's not. They can't borrow on that. It's not like they can take it to the bank and say, "I'd like $1 billion loan, please."
Yeah. I mean, what I was impressed by when I read the S1 filing is that in 2020, they did $161 million in revenue.
Okay, listeners, I just want to point out, she just said, when I read the S1 filing. Because at night when someone else is reading a book or watching sitcoms, you're like, I'm going to read an S1 filing.
It's just impressive. Like in 2016, they were a company that only made $1 million. And so as someone who knows people who have worked at Duolingo when it was not making any money, to then seeing it generate a revenue, a revenue model, and then to see it go from $1 million to $161 million in 5 years. Yeah, I don't know. I'm a nerd. I'm like a startup geek, and I actually really love seeing the trajectory of companies like that.
So you said earlier that you learned 2 languages. When you say learn, you're conversant, you're conversational, you have a couple of words, you can actually get on and off a bus. What kind of stickiness was it as a learning experience?
So for Spanish, I learned Spanish in school, but Duolingo is like a good refresher. And then I don't know Italian, and I learned sort of basic conversational Italian before I went to Italy 2 years ago, and I
Was
used
it
Duolingo to do that.
was it fun?
Yeah, it's great. It's like it has like cool, cute little cartoons, very practical phrases. It's gamified. Like you have streaks where you're like, oh man, I need to like log into the app and do some questions, otherwise I'm gonna break my like 48-day streak.
I wonder what percentage of Duolingo users are tied to an upcoming trip. Because that would be what would motivate me, is not wanting to be, in a country where I don't speak the language and essentially maul their language and be humiliated by that.
Yeah, you know what's really funny is they have like other like fake languages like Dothraki. They have like a Game of Thrones language on there. It's also like an entertainment app.
Fascinating. All right. Well, so let's just poke into a couple more of these, and then we'll look down the road for a minute. What else? I mean, there's some bad stories, right? I mean, Uber IPO'd and then kind of fell off a cliff.
Hmm.
WeWork IPO'd and kind of fell off a cliff.
Well, it was supposed to fall. It was supposed to IPO, and
Right.
then it did not. It like fell off a cliff, and then they SPAC'd, and now they're public.
They SPAC'd. That's a different show. um, but like, I guess my question is, not to put too fine a point on it, like, if you needed to make money, if you needed your portfolio to earn money, I guess what I'm warning our listeners is, you think, oh my God, Roblox is coming out and it's going to be IPO, and my kids use it and it's really fun, but a whole lot of smart money has already, kind of cranked up their return. Like, you think you're coming into a new company, but you're really coming in at the end of a cycle. So it may be a rocket ship long term, but like, I don't know if I think Roblox is going to be, a 10x return for the IPO investor, over the next 5 years. Maybe.
I think it's just so hard to tell. I think everyone wants to make these bets in these new IPOs that they're going to be able to consolidate a market in the way that Facebook is as dominant as it is, or let's say like Microsoft, LinkedIn, Apple, like big tech. Like being the first mover in a space and either making a market or being in a position to disrupt and consolidate an existing one, that's really what you're banking on.
But
I mean,
like,
look at Tesla, right? Like Tesla is a car company, but why does it have the valuation that it has? Because it's not just an electric car, it's also the infrastructure around it.
well, and Elon is a showman, and and it's fun to say at a cocktail party, oh, I own shares in Tesla. Although, are we having cocktail parties yet? Maybe at some point it will be fun. But like, I guess my question is, like, to be fair, I've not used Robinhood. So, is Robinhood an investment vehicle or is it gamified?
I mean, it's trying to be disruptive in terms of like democratizing trading, right? That's what they'll say. How do you make the average person a day trader?
I think if you're talking about $25 or $50 and you can afford to lose it, I mean, that's, this phrase that people understand in the investment community is, accredited investor, which means you have enough money and you're liquid enough that you're going to invest money you can afford to lose. I'm not sure. I think that people that are on Robinhood can afford to lose, a month's rent.
Right.
And they don't limit how much you bet, right? There's no, hey,
No, if anything, what's dangerous about Robinhood is that their entire business model is basically off of trades. Like they're taking a percentage of the trades. So it's almost like the more they can gamify the app experience so that you're making transactions, the better their business is doing.
So let's go back for a second. As we were getting into this pod, I remembered that you were at a company that went public, but to be honest, you've been to so many interesting companies, I couldn't quite remember which one it was. Is that a secret that you don't want to share, or does it not matter?
No, I used to work at 2U, which is we IPO'd at $11 a share, and it went all the way up to like 90 something, and then it had a market correction, and now it's trading at like 46.
So all right, I'll ask one more probing question, and you can tell me, when I've crossed the line into personal Alexa finance. I won't ask how much, but did you own shares when it hit 90, and did you sell?
I did not sell at 90, and I still have all of my shares. I've never sold them.
And do you look back and think, damn, now in the rearview mirror, that was the peak? Or you think the best is yet to come?
I still think the best is yet to come. So this actually goes against the once you go public, like you lose innovation. Yeah. So the education market is so big, and the way 2U has operated, they first were tackling graduate degree programs, and then now they're doing like courses. We talked about edX in previous shows, but like there's so many different segments of online education that they can tap into. So I still think that they have a long way to go. And yeah. But I think innovation often post IPO happens through the lens of like M&A, mergers and acquisitions. I don't think it comes from the inside. I actually think it's like, oh, who is innovating in a space? And then how do we acquire them and integrate them into a business?
So Taboola just IPO'd, and they, as of 2 days ago, did an enormous acquisition that I like, which obviously was in the works, before the IPO. But all right, well, we're running out of time. Is there a do we want to synthesize this into a conclusion? IPOs for startups, good, sideways.
It can go either way. I was also at a company that didn't IPO, but it got bought at the same valuation as 2U did when they IPO'd. So you can have, I think, getting bought, going public, staying private. It's the journey, not the destination.
It's the journey, not the destination. All right. Well, okay. So I'll sum it up a little bit on a slightly tighter box than that. Pay attention to the IPO space. There's no evidence that it's going to slow down. SPAC, we'll talk about SPACs another day. But I think we're going to see a very, very hot IPO market for all kinds of reasons. People have cash, people have stayed home, people aren't going on vacation, people have free time on their hands, people are sitting in front of their computer.
And markets are changing.
Yeah, and markets are changing. I'm going to go right out after this pod, and I'm going to buy a whole bunch of shares of GameStop.
Oh, jeez.
Not buying GameStop. All right. Have a good week. See you next week. Bye.
See ya.